Goodwin folks for having me here. There's some irony because we try to use Goodwin over and over and over again, but most of our partners use Goodwin, so we get conflicted out most of the time. So thank you also to David. Thank you to Kristen and Chris and Sten. I appreciate you guys inviting me to be here. So I'm third generation member of the Grau family. GFP Real Estate is our real estate arm. We basically have two different parts of the real estate business. One is the commercial office portfolio. I'll spend the first part of this talk on what's happening there, and then the second is new business, which mostly is development. And as David said, we're doing some large office or residential conversions. So just to give a little sense of GFP, so we own more than 13 million square feet, soon to be 14 million square feet. We control 17 or 18 million square feet. It's roughly 4% of New York City's office stock. We have approximately 2,500 tenants in our portfolio. So what that means is that our tenants are really small and medium-sized businesses. We are the largest landlord to small and medium-sized companies. What we think about our business is sort of like an airplane model. Every day that the seat is empty, we're losing revenue. So we're trying to be leased as much as possible. 90% of the companies in New York City are 6,000 square feet and smaller. So there is a huge volume of these folks. Just to give you a little bit of sense of the quality of our buildings, we usually are best in class. We're as good, if not better, than all of our peer buildings. So if you are a tenant and you come to our building, you probably will perceive it to be a better value than you would to our others. And some ways that shows up is if you're a New York City person, you understand about Local Law 97. So all of our buildings pass 2025 Local Law 97, and all of them will pass Local Law 97 in 2030. Really simple business model. Just want to be nice. And then the number two rule, like I said, is just we hate vacant space. So our development team has done a number of different projects. The one we're probably most well known for is David Geffen Hall at Lincoln Center. We also did the headquarters for New York City Health and Hospital, the 7th largest employer in the region, as well as the Securities and Exchange Commission's headquarters here in New York City. Okay, so one other thing I'll say before I move on. And as I go through some of these slides, it's relevant. So one thing about our model is we try to renew our tenants. It's less about the top line revenue dollar. It's more about the total cash flow in our portfolio. We completely understand the private equity side. Almost all of our new ventures are with large private equity firms. But at the same time, from a family perspective, we are cash flow operating businesses. And what ends up happening is that renewal rate, which was 90% pre-pandemic and is creeping back up, basically results in lower TI and LCs. Okay, pre-pandemic, we were less than 30% loan to value. I think that's probably why I'm still standing here as the largest landlord to small and medium-sized businesses. We'll have some good news I'll talk about, and then we'll talk about some reality as well. Okay. All right, so here is our revenue in 2014 dollars. So it's a little interesting. Some people I tell are surprised the fact that our revenue is up from 2014, and you can see the pandemic took a giant chunk out of it, but we are recovering and recovering slowly. But why are we recovering? Part of it is about improved collections. Small and medium-sized tenants had a really, really difficult time in COVID. Part of it is actually that our absorption has gone up. So we dipped from 99% occupancy to roughly low 80s. Now we're back into the low to mid 90s. So office is not dead in New York. There are plenty of tenants out there. They are leasing space, and we are growing our occupancy. And then, look, we have a lot of leases, and they were long-term leases, and we're fortunate that those tenants that are paying higher amounts as their leases escalate. Here's a slide. This is just the leasing commissions that we pay in 2014 dollars. You can see it does vary. You can certainly see the dip in 2020, and now this recovery that I've been talking about. One of the big challenges is profit margin. So our operating expenses continue to rise. There is inflation, as we're all very aware of, and that inflation really there's nothing we can do about it. It's something that our oil costs, our labor costs, our materials costs are all just going to go up. So what does that mean? It means that our profit margin has been challenged. So pre-COVID, business was very good. Our operating margins were increasing. COVID, you can see a tremendous dip, and now like I said, a recovery, but not nearly a recovery to where we were. One thing that's, as a New York City person, and my guess is most municipalities around the country are probably dealing with this, is so clearly our profits are down, but somehow our taxes based on the value of our building is up. And that disconnect is, disturbing for those of us who have to pay it, but I think it's something that's probably very concerning from a municipality perspective. And at some point, I guess the chickens will come home to roost, and the fight that we're having with the Department of Finance and eventually the law department, I think will play out. And if history is any guide, at some point, once there's a number of cases, a certain number of cases, the city will settle them and they will lose revenue, and that will be an issue. No shock here that interest expense is rising. Our LTV, like I said, was less than 30% pre-COVID. You can see that because of the interest, even though it's not, it is a big part, of course, of what we're spending, but it's not the biggest, and it is clearly hurting profitability. Okay, trying to think about the world of 2014 versus the world of 2023 from an office perspective. And forgive me to all the professors that are here for my super basic perspective. Okay, here's a building that either we owned or we were looking to acquire. This is from a private equity perspective in 2013. They were going to buy this building for roughly $340 a foot. They were going to put $250 a foot of debt on it. Here's where the building stood when they bought it. And then what they were trying to do, what we were all trying to do, is clearly raise rents in some respect. There's some back of the envelope math on what average TI dollars would cost, average base building, and basically the expenses to run an asset. This is like a back of the envelope that probably ties into this most complicated Excel models. So this was a good thing because we were getting better rent, we were getting much more value as a result, and we were making a lot of money. So everyone was very happy. Okay, 2023. I wonder what's going to happen here. So the in-place rent, shockingly, is probably about the same, at least in our portfolio in the B world. I wish we lived in the AA world. We don't, and the rents have pretty much flatlined from what they were in 2023. The reality is that they probably are still trending lower because the mark-to-market as leases expire are coming down. Interest rates clearly going up. When you have cap rates going up and you have a lot of debt, you also are going to have a lot of interest expense increase. So $10 a foot, let's just say for the private equity shop in 2014, you're now looking at like $16.25, let's just say, or more. So it's a huge hit to the bottom line. And then what I talked about with the slide about operating expenses and taxes and TI costs, you're really crushing margins across the board, right? So you basically eliminated almost all the value in office, and that's why we're seeing a collapse. This is hopefully not a shock to anyone, but it's really unfortunate. Okay, I'm gonna do the exact same thing, but I'm gonna give you from the family-owned perspective, right? And I think that in the B space, there's probably more of us than there is in the PE space. And so the same building that we, let's say, owned at this point, maybe we didn't get $42 a foot, we just got 40 because we'd rather just take a tenant and have it occupied. This asset, of course, was increasing in value, and we were also happy at this point. Now we have, like I said, a $42 rent, so we are making more, let's just say, than we were a decade ago, but the expenses have really increased a lot. The interest is only a small portion of it. If you look at really, sorry, I'll get to this in a second, if you look at really the delta, the $13 a foot, let's just say, of cash flow that we've been hit by, the interest is a portion of it, but really the operating expenses, taxes, and if we had to re-tenant a building, which again, we try to be nice to our tenants, we try to have high renewal rates, we try to take a little less in revenue in order to avoid the TI, LC costs, because you can see on this slide that that is really what the profit margin killer is. So not necessarily a private equity perspective, not a merchant build perspective, but if you're a long-term owner, these are the kinds of things that we think about. The interest rate is important, but really what's important for us is the cash flow. Sorry, a lot of circles, a lot of slides. And clearly we're not happy. Okay, that's the office portfolio. What I think David really wanted me to talk about is mostly the new projects, some of which I mentioned before. Basically, our team has done over $3 billion worth of projects in the last 5 years. We have another, hopefully, $1 billion in the pipeline right now, some of which have been announced in the press. For office to residential conversion, my opinion, there's 3 things we got to have. So one of them is we need to have it as of right. So New York City is a great place to do real estate because they actually have a zoning code where as long as you follow it, you can do it. You do not need to deal with the politicians to get entitlements done. We will not look at a project that requires entitlements. It is just too difficult, and the political climate is too difficult as well. We need a path to vacancy. So in order to make the building residential, you need the office tenants to get out of the way. We'll talk about this in a second. And the third thing is we need economically viable. A little bit more on as of right. So here are the basic criteria we look at in-house. In New York City, below Murray Street, if the building was built before 1977, you can convert the entire building. In Midtown, or below 96th Street but above Murray Street, if it was built before 1961, you can convert the entire building. If the building was built after these dates in these neighborhoods, you can only convert up to 12 FAR, assuming the area is zoned for it. Believe it or not, in Manhattan, there are a lot of manufacturing zones that do not allow residential. So the Garment District, Chelsea has huge swaths of it. Up until 2 years ago, Soho as well. So a lot of the B buildings that we own and others own are in these districts, which actually are not zoned for residential and are not allowed to have residential at all. The city has a program called City of Yes. If you don't know about it, I would recommend reading about it. It is going through the code and trying to make it a lot easier for conversions. The challenge is the state really controls the 12 FAR cap. So smaller deals will be, I guess, fine. Bigger deals will have the issue until the state changes it. Okay, path to vacancy. Most commercial buildings are just not vacant, or they're not all vacant. Most landlords like us and others will stagger their expirations. So you can convert around these tenants. Again, if you meet the dates and the neighborhood that these assets are located in, then you can put residential below commercial. If you don't meet the dates and you don't meet the neighborhoods, then in that 12 FAR, you can only put the residential above the commercial. Complicated. If the tenants are in a contiguous block, it makes it a lot easier, but these are some of the mental and physical gymnastics that we're trying to do. Okay, economically viable, this is really the $1 million, billion-dollar question. So conversions are much harder than ground up. We have a team of, project we'll talk about in a minute, we have a team of 20 people that basically sit on site and just have to resolve all the issues that come up in these buildings that were built, where the as-built drawings don't actually match what they built in the field. The returns clearly have to be higher, right? All of the equity, all of the debt, all of the players in the capital stack are going to require higher margins in order to greenlight these projects. When you can get to the greenlighting the project, the amount of debt available is in the 50 to 60% range. You're looking at much higher rates for that upper end of that bell curve. And then it, of course, requires much higher equity. Clearly, debt costs are high. And then the other side of this is, so as the general partner in these projects, I can tell you that when we were doing projects in 2019, so right before COVID, the difference in the guarantor requirements from 2019 to 2024 are roughly 3 to 6 times. So we need to be able to put up entities, because we're not signing personally, that have that kind of net worth and liquidity to do these projects. And then, of course, if we don't know, New York City politics are challenging. I will say that this year, for the first time in the last 5 years, the mentality amongst the conversations with elected officials has really changed. And I do think people are on the same board and wanting affordable housing and wanting to be able to create residential. Whether it happens or not, I don't know. But I can tell you the mentality has changed. Okay, equity requirements for these projects. 7% yield on cost or greater, IRRs that are at least in the low to mid-20s. We have to put up just huge contingency reserves that are different than a ground-up development project. In order to buy a deal, longer diligence periods, lower land value, clearly we need to try to buy it for as little as possible. And then we've seen some creativity on sellers' parts where they're providing financing or they're actually writing equity checks into these deals themselves and sort of maybe creating like a hope note of some sort. And then the affordable housing side of it is, it just doesn't pencil without some incentive. There is no way to do it, and as much as I, as an individual, would like to see affordable housing for New York City, we really need government to help us come up with these programs. Okay, some other things. Look, this isn't for the faint of heart. There's problems all the time. These are surgery at times in these buildings. You need a partner who can really like roll with these issues, and we happen to have some great partners. I'll just give a shout out to Rockwood, who's been unbelievable at 25 Water, and TPG at 222 Broadway. The team that you hire has to be experienced. There's so many that want to be in this space, but they just haven't done it yet. And if you haven't done it, you really shouldn't be trying it for the first time on a $500 million project. The development team that we have is just trying to come up with solutions. Our schedule for 25 Water, which I'll go through in a minute, is 30,000 lines. There's 30,000 lines to the schedule. It's a sequence project. We are building a custom building, and if anything gets out of sequence, you can screw up everything behind it. And so you have to be able to adapt and change as you're going through these. I'm going to go through a couple of the qualities of the buildings that have to get built, how you turn this office building into a residential building. So one is legal light and air. Another is getting to an efficiency that is at least 80%. These office buildings are deep plates, so they're difficult. There's something called a 5% rule. I'll show you an example of what that means, and then we'll talk about amenities. There definitely is an amenity war. Okay, legal light and air. Here's two projects that we have. These are before pictures of both the assets. The one on the left clearly has a lot of windows. The one on the right does not, right? People say, isn't there a type of building that you need to find in order to create a residential building? And I think 25 Water, which I'll spend a lot of time on, is an example of why you actually don't need to find the right type of building. I think that what ends up happening is you just have to pay less for it, right? There's just more gymnastics that have to get done to turn it into the right kind of building. So it's just really about the basis that you're buying it at. So how do you turn the building on the left, which to me looks like a jail, into the building on the right, which we think is beautiful? So let's just start by having to strip off the facade. So we literally have to scrape the brick off the building. This is a little bit of what it looks like. This is a picture taken about a month ago. So you can see that literally the bays that are on the building have been, the brick has been removed. Light wells. So we are carving 2 light wells into this building. We are not the first to do this kind of thing, but we are carving 2 into a building that has basically a 50,000 square foot floor plate. It's almost like a football field when you look across it. So these 2 light wells, people ask like, well, aren't you worried about how it feels like if someone's apartment's on, in that light well? So this is a picture of Gloria Vanderbilt's mansion that was sold for a record price a few years ago. It's one of the largest mansions on the Upper East Side. So if you took her mansion and you dropped it in, you could actually fit it into the light well, and there's a lot of room all around it. So these light wells are actually really large. Here's us carving the light well out. This is probably a year ago. You can see the size of these 2 pieces of equipment. My guess is if you put these 2 pieces of equipment in this room, they would take up most of the room. So you can start to get an idea of what it actually feels like. Here's a picture I took with my cell phone from the bottom of the light well in, I think, January. So let's say the darkest part of the year. There's no lights in this building, and you can see that there actually is pretty good natural light that comes through. So we have 2 of these. Let's see. Most commercial buildings have a lot of excess elevators and stairs, right? Commercial density is much higher. You have a lot more people on a floor at one time, so there's a lot that can be removed from these buildings. So once you have the excess FAR, you actually have to be able to use it. So this is a floor plan of the tower portion that we're building on top of this asset. So we're building 10 floors on top of a 22-story building. So that's where the excess FAR goes. It's probably hard to tell just looking at a floor plan, but the efficiency of it has to do with the amount of iterations this plan went through. There's probably up to 100 iterations of this floor plan that were done in order to create that efficiency. This building will have roughly 86% efficiency. New build residential is lucky to get into the 90s. Okay, here's the new build on top. This is a month or so ago, and you can see the lower portion. Here's the new build just from standing on the what will be one of the amenity floors of the building. All right, 5% rule. So most people probably haven't heard of this. What does it mean? It means that if you change the surface area of the building by more than 5%, if you grow the surface area of the building by more than 5%, you have to bring the building to modern structural code. Modern structural code means for buildings that were built before 1977 and certainly before 1961, lateral bracing. So lateral bracing looks like that. It is everywhere. There's another picture of it, and you can see how the facade was carved out. So what's challenging about the lateral bracing is cost, clearly, time, because you have to install it before you start building on top, especially. But also, it's difficult to lay out the floor plan, right? You have to figure out how to get through these into apartments or into bedrooms or down a hallway. So where these are placed and how they're laid out makes it extremely challenging. So when you do all that, you remove the excess core, you carve in the light well, you put in the lateral bracing. This is sort of what you end up with. And so in this asset on what was an office floor of 50,000 square feet, we will end up with roughly 52 apartments. Amenities. We are in an amenity war. I think that it's great, actually, as a consumer. Like, you can basically live in a resort. This asset will have almost 100,000 square feet of amenities. So we're taking a 1.1 million square foot office building and we're turning it into a 1,300 unit residential building that has 100,000 square feet of amenities indoors and out. This is just a picture of the 25th floor. It's where I took that picture of the tower being built. This one has an outdoor pool, social lounge, relaxation lounge, has a co-working facility. It has a private dining area. It has outdoor barbecues. It has a lawn. It has like pretty much anything, a pool table, anything you can think of is pretty much going to be in this building. And just some pictures of renderings of what you have to build and the kind of quality you have to build to is what will be put into these assets. You know, bowling alleys, indoor pools. This building will have 2 pickleball courts, a basketball court, yoga studio, Pilates studio, spa. It's a place that I want to live, honestly. It's going to be a great building. Okay, back to the sort of the matter at hand of the economics of how this works. So if you had an empty office building that you could buy, and you could buy for the bargain basement price of $133 a foot, what's happening clearly in the office market, just $45 foot rent, 500,000 square foot building. By the way, 500,000 square feet gross turns into 600,000 square feet rentable, right? We have to do this rentable to, gymnastics between office and residential. So assuming you buy it for $133 a foot, in order to take an office building that is empty and really improve upon it, you are going to spend at least $250 a foot. There's just no way around it, and that's probably a low number. That gets you to a gross square foot cost. We have to break this down into gross square feet, not rentable square feet, approaching $600 a foot. If you get 45 bucks, you end up with $24 a foot on a gross square foot basis profit. Forget the cap rate. We're just throwing in something. I'm a developer and an owner, so I want lower cap rates. You probably don't believe in that lower cap rate. But what you probably believe in and understand is the yield on cost. So the yield on cost for buying an office building, even at the bargain basement price of $133 a foot, if you can't get more than $45 a foot, B building, you're just not going to do the project. It's just not going to pencil. Same building, 500,000 square feet. It's 80% efficient, so this is probably the least efficient we could do to make this asset make sense. That turns into 400,000 square feet of rentable. we're spending probably about the same on a gross square footage. There's a lot of range to it. If you're stripping the facade off the building, you're going to spend a lot more. If you're adding to the building, you're going to spend a lot more. But a vanilla conversion, you're going to spend roughly, let's say, $300 a foot in hard costs. Gets you to a total cost south of $600 a gross square foot at $100 a foot in rent, which is really where the market is trending for new build residential product. You're going to end up in the $40 foot range. Forget the cap rate. You're going to look at the yield on cost, 7%. You're probably greenlighting this project. At least we and our partners are greenlighting this project. Okay. When would you do an office building? When would you not go through the gymnastics to actually turn it into a residential building? So same asset, looking at a rent now of $78 a foot. I was just trying to pick a number that sort of got to a yield on cost where you might actually be willing to do it. And at a 9 yield on cost, you might get into the territory of being able to greenlight an office building. I'm not sure even a 9 yield on cost would get greenlighted, but that seems like what you might have to do to get it done. Okay, I'm almost out of time. We're going to put a time-lapse video up of the 25 Water project, and we're going to do a little Q&A in case you have questions. No questions? All right, we'll watch the time lapse. So this is 25 Water. It's a project that we own with Rockwood. MSD and Apollo did our financing. Goodwin really navigated us through this one. This was a very, very difficult closing. We closed in December of 22, which is probably the worst financing market I've ever seen in my career. But they got it done, and the project is now 3 months ahead of schedule. We are within 3% of cost, and we have, I believe, over $20 million of unallocated contingency. So what many probably thought was not possible to get done, we are well on our way to getting done, and our first TCO is scheduled for the end of this year. So project started December 22, first TCO December 24. Go ahead.
What percentage of the office stock in New York City do you think that can be done?
People ask me that all the time. The hard part is that most buildings are occupied. They just are. So when we're looking at these assets, like there's 6 buildings on the market right now that are 40% occupied, but their tenancy has 5-6 years, and the block of space, the 60% that's not occupied, is like all over the building, right? So the risk you have to take as a developer is that somehow you can convince all these 40% of tenants to leave, or leave without, taking a lot of money. But really, it's the money's important, but the time. If it took you 4 years to do it, you would sink your equity, right? So it's a really hard question. Go ahead. I'm not the right person to answer the question. We only work in New York City, so I couldn't really tell you. The one thing about New York City that I think is really fantastic is as-of-right zoning. Like in a lot of other municipalities, you have to go get permission. Even in Jersey City, where we own assets, you have to go to the mayor, you have to go to the zoning group, you have to bet that you're going to get permission. And they try to make a clear path for you, but you're not assured of it. In New York City, you're assured. Thanks. Yeah. The good news is that we're really not the pioneers here. So there's been a lot of other groups that have done it. Look, the supply of Manhattan residential buildings has almost come to a standstill, right? And the demand is really still there, and we see it in the rents. I mean, that's why rents are month after month after month going up. And So the city and the state haven't come up with a plan to create more residential en masse. And our peers that have done this ahead of us lease up buildings that are 300,000 square feet in 6 to 8 months, right? So yeah, will a 1,300 unit building take longer? It will, but this 1,300 unit building has 100,000 square feet of amenities. So when someone's considering where to live, it'll be a bigger building, but you'll have so much more, right? Yeah.
Column spacing and stuff like that?
It's a really good question. So most office buildings actually have really tall ceilings, taller than residential would be built. So they're more desirable than buying like a hotel and converting it from a physical perspective. This building has column widths that are 30 feet, right? That's pretty good. If you're looking at an 18-foot, which is like a 1920s construction, it's a little bit more challenging to lay out. So look, getting to the 80%, at least 80% efficiency is key. And I think you just need experience doing these over and over and over again.